Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address everything you need for a healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. I am your host. Thank you for joining us. Excuse me as I recalibrate my outfit. Recalibration. Oh no, not again. It hurts so good I don't understand. Recalibration. Is that from the 80s or 90s? Anyway, recalibrate was the word of the day at the Fed conference. Powell said it, I think, 9 times. They lowered the Fed's fund rate 0.5%, fairly big cut. They had raised it 11 times from March 2022 to July 2023, a total of 5% increases. We had been near zero. Cheap money had been the norm, at least since the financial crisis. Raised it to fight inflation. Inflation was out of control. Maybe not Venezuela out of control, but it was pretty rough. You know what? I think we have a little montage. We'll play the Powell. He says it better than I do. The recalibration.
Maintain this recalibration of our policy stance. It's a process of recalibrating to recalibrate. We're recalibrating policy, recalibration of our policy, and begin to recalibrating it. We're recalibrating our policy over time.
And as we look forward, and because we want you to have a healthy and wealthy retirement, we have 4 things for you to recalibrate. Number 1, mindset. Your mindset should be changing a little bit. The fear of runaway inflation should be really over. Now, we don't know for sure, especially when you're talking about external shocks, when you think about a 9/11, when you think about before my time, the 70s of the oil embargo, late 60s to 70s, or other geopolitical stuff, those, or COVID. Those are things where you really tough to plan for. We have to plan with what you know. Mindset is inflation is probably done. You could probably think about at least runaway inflation. Think in terms of 2 to 3%. The idea that we are at least higher for longer than we used to be, than we're used to, kind of more longer term normal, not the last 10, 15, 20 years normal, but before that. 3% is not horribly unusual. Especially since we're onshoring. I know it's a source of kind of political debate, but if we're onshoring, we're probably looking at a little bit higher inflation there as well. So think in terms of 2 or 3%. I'm glad the Fed did not wait until exactly 2. I found that philosophy to be the perfect being the enemy of the good. The idea that we can't have a healthy economy, job market, stock market, and bond market with 3% inflation, especially if it's declining some. So think 2.5. I think also a widespread recession is probably off the table. I think a slowdown is still possible. I would say if the probability, I don't think the probability is kind of towards the norm, because there's always a possibility of a recession. But I'd say it's even a little bit higher. I don't think it's great. But just because it's so tough, and we'll put up the slide here, it's so tough to have a soft landing. I think this graph goes back 40 years. I think it's one time. So, and it makes sense, especially given the nature of this. There's just no free lunch. There's good and bad. You can't have the good times without some bad. So the odds of a soft landing are low. But that being said, I think if you were thinking in terms of probability, think in terms of lower inflation, lower cost of money, and that a severe recession is probably off the table. The idea that we maybe still have some rolling recessions, the tech industry saw theirs, they handle it really well, they'll downsized. Not fun if you're a tech employee, not fun at all. And that's why financial planning is so important, is that you are preparing for some of those worst case scenarios, not just to live through them, but maybe even take advantage of them, where you can buy some of those tech stocks when they're down. But overall, things are looking good. I think the odds are a soft landing. I think we have a picture of Powell himself showing us what the soft landing looks like. So overall, soft landing is probably on the table. I think you really have to plan that way. Maybe in some ways, maybe you think about planning a little bit on the margins for a harder landing, maybe a higher, depending on your industry, higher emergency fund. Maybe, given fixed income does pay more, maybe you overweight that, but make sure you're in position to take advantage of some of the growth. That brings me to number 2, your portfolio. The biggest change is fixed income. Hiding out on what they call the lower end of the curve. So the short duration cash like 0 to 2 years where you're getting 5%, those days are numbered. I saw some short duration ETFs that are still yielding 4 to 4.5%, and I'm getting some clients out of those. And I'm leaving before that goes away because I want to lock in some things that are maybe further down the yield curve. The best time to do it was probably a month ago, and we started doing this two or 3 months ago, is to do it before it happens. But it's probably better to give up some of that 5% yield, knowing that it's going to expire and you're going to have reinvestment risk. And that's the key word, reinvestment risk. So you might still you might have bought a bond 2 years ago, a 2-year bond yielding 5, has another year to go. Now, depending on your use for that money, it might be worth it to hang on to it for another year. But do you want to reinvest that at 1%? And we don't know, depending on how long down the yield curve, how long you want to lock up your money for. That might be a good or bad thing. Or do you want to, say, buy a 3 to 4 year % bond, maybe going out to 10 years, because that might suit. If you're looking for a ballast during a recession or depression, it might be a good time to do that. You can't time the top or bottom of anything, but yields are probably still going lower. Now I know the Fed has the biggest impact on the short end of the curve. The long end, there's lots of different factors there, and the 10-year could go a little bit higher. But I think the error is on the downside. I'd rather, if I'm a retiree and I'm concerned about something that's going to really act as a ballast and give me some income as I'm in retirement, I think I'd rather give up a little of that short-term stuff to be safer in case something does happen. And we'll show a yield curve slide here. So as you can see, one is from recently here. I think we pulled this right after the chairman spoke, and one is from a year ago. So most people, when they think about an inverted yield curve, they think about the 2 and 10. And you could see here a year ago it was inverted, meaning inverted where you paid more to loan the government money 2 years than for 10 years. Normally that's reversed. Uninvert, if that's a word. And that makes sense. If you're loaning someone money for 10 years, you're giving up the use of your money longer. You want to be rewarded more for giving up that money longer, not have the use of it. So that is probably changing. So definitely the short end's coming down. As far as getting out in the 10-year, and you can see here that the more current curve, and some of this happened in anticipation. The nice thing about the free markets is that people, and sometimes they're wrong. Sometimes people guess and they're wrong. Sometimes they, if the Fed had come out with something different, or especially if they had raised, you would have seen something dramatically different happen. But the market often tries to anticipate these things for right and wrong. So right now you can see here, from the 2 and 10, it's uninverted slightly, but that's still there. And then if you go out further than the 10, you can see that's even higher. Now on the very short end, you're still seeing some yields that are quite high. And again, you can find that with some ETFs that invest in short dated maturity bonds that's still there. You could still take advantage of those. And if it's kind of an emergency fund and and something you're going to need right away, by all means, do it. But if it's something where, you might not need it for a year or two, maybe because it's, quite often we don't tap our emergency funds right away, but especially the fixed income portion of your portfolio, it might be time to give up that 4.5% to 5% yield to lock in yields higher because you'll be better off longer term. Will you be better off over the next 6 to 12 months? Probably not, but longer periods you will. So the cash, hiding out in cash, that high cash rates, the short maturity stuff, those high yields are probably going away. For equities, you could think in terms of it's pretty good. The equity market, for good and bad, it doesn't fight the Fed usually. The Fed always wins. It's BFE, big Fed energy. Some sectors that do well, consumer discretionary is one that comes up. We had a blog post where that was mentioned. After we did it, I kind of went in and tweaked it a little bit, saying I think the consumer is stretched. I think consumer discretionary, maybe at the very high end, could start doing well. I'm a little more concerned about consumer discretionary at the mid to lower end, just because the consumer is a lot more stretched than it was 2 or 3 years ago. People are still kind of hurting from inflation because prices haven't come down. If decreased inflation means things just don't go up as quickly, but the idea that one of my sons loves steak, the idea that steak is going to price cut in half, like I think it seems like it was just 2 years ago. I don't think that's going to happen. I hope it does, knock on wood. But it's consumer discretionary concerns me, but you can think in terms of other parts of the market, like say industrials or small or mid. They benefit from cheaper borrowing costs. And those parts of the market also, from a fundamental standpoint, meaning valuation and or earnings growth, look a lot better. So if rates stay low and the economy stays good, those probably should do better than some of the momentum stocks. And large growth often are their momentum plays. So it's the mood of the market. And as far as kind of a shorter term, not even short to intermediate term, because it is tough to deny that momentum is a thing. We tend to get caught up with stuff, and sometimes that momentum can last until it's actually true in some cases. So momentum. I'm not knocking momentum investing, but it is often more of a short term, more gambling-ish type thing. But the broadening out of the market is probably going to happen. It's not that these tech companies are bad. It's just that they've been kind of priced to perfection to some degree, meaning the earnings growth there, relative to the price you're paying for those earnings and earnings growth, just aren't as attractive as these other parts of the market. Now, that's been going on for some time, and if we have another AI boom or an AI frenzy, and that's where even the market was kind of punishing some of these firms because it's concerned. It's concerns about, when are we going to see a profit for all this AI investment? And so I think you're going to see that. I think that a couple of the main takeaways are you really do need to think in terms of rebalancing and your asset allocation relative to your goals and your risk return profile. If you have all your money in a few handful in the Big Mag 7, big tech, and you're planning on those funds for a long retirement, I'd be a little concerned. Not that they would do bad, but we've seen cases where some asset classes has had lost decades, not because they did anything, even like companies like Walmart, not because they did anything wrong. People got excited about them. They bid up the price of them to where it could take a decade for Walmart to grow into what was already priced in. And Walmart executed, they did what they were supposed to, but the stock could not grow very much or be flat. So in the shorter term, the market is often a voting mechanism. Longer term, it's a weighing mechanism. And I think you definitely need to, it's a good time with the markets being near all-time highs for most asset classes. It's a good time to rebalance, say, you know what, I'm going to take some of that profit. I'm going to look at international emerging markets and diversify. So rebalance, diversify, revisit your asset allocation. Also, it might be a good time to look at your income sources. If you're ideally income, especially in retirement, should be total return, but often it's some combination of having dividend or interest payments. So looking at your fixed income, looking to see if dividend paying stocks are attractive. Some were hurt because some of these dividend stocks were bid up, meaning they got expensive because yields were so low years ago. Well, if those were beaten down because why would I buy a risky stock that pays 2 or 3% when I can buy a 5-year risk-free treasury, 2-year treasury at 5%? So that might change. I mean, I don't think the dividend yield should wag the investing dog, but now might be a good time to revisit some of those dividend sectors. And as I mentioned, some sectors might benefit from the cost of capital. Lastly, we're going to talk about mortgage use of debt. So mortgage rates dropped kind of in anticipation of this. Mortgage rates are more tied to the 10-year treasury than they are where the Fed has most impact in the short term. But they went down. I think the error is probably on the downside. I think you could argue that there is some there's a decent argument that the 10-year Treasury should be at least a little bit higher. But you're seeing the cost of debt to go down. If you were thinking about moving or refinancing, now might be a good time. At least get your ducks in a row buying a home. Most of the time people move, and we have a slide up when it's either diamonds, diapers, degrees, divorce, and death. So the 5 Ds, and that's why people weren't moving, or they wouldn't move unless they had to because they didn't want to give up a 4% mortgage for an 8% mortgage. But I think that might be changing, and you've seen refinances really tick up. So part of that mindset, more certainty, means that if you're not going to refinance or make that move on a home, or look at your debt, look at credit cards, look at HELOCs, home equity line of credit. Start to negotiate with the credit card companies. That rate usually takes longer to come down. Maybe if you were thinking about using your HELOC, those rates usually time to prime, which are more directly affected by the Fed. Those might look good. So there we have it. It's time to recalibrate, and it's time for you to recalibrate your mindset, your portfolio, your emergency fund, and your use of debt. If you do those things, you're going to have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe right there. You can do it. You got this.